Okay, hi everyone, and welcome to today's webinar on Division 296. So the title of today's webinar is Turning Implications into Action. So I'm sure we'll hopefully see lots of that today. So a bit of housekeeping before we start. My name is Jeevan Togi and I'm your host for today. So today's session will be recorded, so you will receive a link to recording if you'd like to share that, or if anything drops out. You will also receive a copy of the slides. So that will be sent post-webinar along with the link to the recording. All of BGL's webinars are generally recorded and are available on BGL's YouTube channel if you want to see any of our prior webinars. So today we brought in a absolute expert, Michelle Griffiths from Tag Financial Services. So I've known Michelle pretty much the whole time I've been at BGL, which is over 20 years now. So a long time there. But Michelle's can probably do a better intro than myself. But I know Michelle, there you're a partner of Tag Financial Services. You lead the investment advisory and wealth divisions. You know everything around financial planning, tax strategies there. You've been a presenter at CPA, SMSF conferences for multiple years and run sessions all around the country. I don't know if I've missed anything there,
I think you've pretty much nailed it, Jeevan.
Oh,
What I'll do is I'll just start sharing my screen so that we can get this show on the road. Um, Making sure that I'm actually sharing the correct screen. That's looking good.
and the last thing I'll mention is any
Yeah,
questions you do have, enter there into the Q&A panel. And obviously, Michelle and I will, try and cover any of those questions as we can towards the end.
right. I will try to have a look at those questions as we're going along if I can. Obviously, trying to stick to a reasonable time frame as well so that we can get you guys in and out. I know everybody's very busy at the moment with deadlines and whatnot. So what I did want to do, in addition to Jeevan's very kind introduction, I wanted to mention the role that myself and TAG have actually been playing in this Div 296, just so that it gives you a little bit of context for how we're approaching this. So we obviously, for those who know us, we have the accounting and specialist superannuation side of things in our business, but we also have the financial planning side as well. And of course, this Div 296 is very much crossing boundaries of all of those elements. So it's really important to understand what it's covered and what you can and can't do or say to clients. So part of today is actually giving you a really good handle on the practical implications of the Div 296. Now, I know that Meg Heffron did a very technical session with BGL a couple of weeks ago on the new rules for Div 296, which means that I have the luxury of not actually having to go through box and dice what the new rules are. So I'm kind of going to make a few assumptions in relation to that you kind of have a fairly good idea about the new rules and what they are and how they're different from what was proposed and all that sort of. So I'm not going to spend a huge amount of time on that. But just in relation to what our journey has been in relation to Div 296 is we were one of the first to just get into doing submissions to Treasury once the legislation was very kindly dropped on the 19th of December, just before everybody broke for Christmas, of course. Alex, just so that you know, yes, we will have some handouts and we'll send those to you after the event. And there's also a QR code that I'm going to share with you during the presentation that will give you access to a case study that we're actually going to go through as part of our discussion point as well. So we were basically working on some submissions to Treasury before over the Christmas break. We lodged them basically on the 6th of January. We then actually finished up meeting with Treasury one-on-one because we were one of the first people to get their submissions in. They were very interested to hear our feedback on what we liked, what we didn't like. And the approach we took was very much how does this affect the client and us as practitioners in a practical sense? Even went to, I know Jeevan made some submissions as well when the regulations came out. Well, in actual fact, we made some submissions before the regulations came out to try to push some elements in relation to the actuarial requirements. So I'd like to think that we had a little bit of a say in modifying some of their approaches there. So simple answer is yes. With as far as Div 296 goes, we have absolutely geeked out on this stuff, and the idea is now to be able to share with you today, particularly, but we'll continue to share information, insights, and really important things in relation to helping you have really meaningful conversations with your clients. That's what today is all about. Very quickly, our disclaimer: this is not personal advice to you nor your clients. If you want to deal with specific circumstances or your clients, we need to meet with you one-on-one, and there's all sorts of rules around that. Okay, so beyond the rule book, and this is the
Michelle,
whole point of today.
Michelle, quickly,
Sorry.
so do you want to change your view? The slides are showing the presenter view.
Oh, okay, sure.
So
Let me see if it's just a matter of. Is that better? Or has that just moved with it?
I think same.
Okay, cool. Let me try that a different way then.
I just have to, reshare.
Yeah, thank you. Screen 2. Okay, is that working better?
Yeah, perfect.
Excellent, excellent. Okay, so today is the practical implications of some of this stuff. What I'm going to actually take you through is a couple of case studies that are based on real life circumstances that we've been exploring over the last several months. So as I said to you, I'm going to make an assumption that you already know the general machinations of the new Div 296. There will be some nuances that I'm going to highlight to you because it's not stuff that's necessarily that apparent from training sessions and stuff, certainly that I've been to. It's application that is now the challenge, and we need to, unfortunately, there is a fairly limited timeline for us to be able to really take advantage of some of the loopholes, let's call it, but basically nuances associated with these new rules, particularly when we're thinking about what we're going to implement for clients. In some instances, what I'm going to also get across to you is that structure drives the outcome. So this is where we've been having some discussions with other accountants, and it's about having a very open and collaborative relationship between the financial advisors and the accountants for the client, because sometimes it is trying to understand what they've already got in place as far as structures, whether it be trusts, companies, and what have you, to make sure that we utilise what's already there if we can, but also to make sure that what is there is actually going to suit our purpose depending on what we decide to do. And the final thing, just in a very broad topics, is that sometimes really what seem like small decisions can actually finish up having really large consequences. I'm going to show you through our case study some of the examples of that. There we go. So the accountant's dilemma is basically, first of all, modifying or navigating the client's expectations. So first of all, one of the things that we need to acknowledge and understand is that the clients are getting a lot of information from lots of different sources. People who've got more than $3 million in super, generally speaking, will be reasonably sophisticated. Not always, but they'll have a level of sophistication. They'll understand how superannuation works as part of their broader thing. So you don't have to treat them like dummies. But by the same token, they've been getting information from the golf club, the newspapers, and quite frankly, some of that information is very one-dimensional and certainly doesn't incorporate all the breadth of things that we need to think about. There are some end of financial year instincts that you might lead to you going, well, we need to do something prior to 30 June. And one of the examples I'm giving you is that maybe that's not the case. Okay. And I'm going to show you an example of the difference between activating some of these strategies on the 30th of June compared to the 1st of July and the significant difference that it could potentially make. Inaction is a decision. And I think that's a really important thing to get across, because I've got a lot of clients who are kind of going, oh, well, it's only going to cost me 10 grand a year of extra tax. Therefore, I'm not going to do anything at this point in time. And that might be the correct decision to make, but my point to you is let's make sure that that is a very conscious decision and not just a default so that they don't have to make a decision, okay? Because that could be quite costly. Once again, thinking about things in a much broader context. Advice boundaries can shift really fast. I was talking to an accountant only last week. Can't see the slides. Adelaide. Jeevan, can you see the slides still?
Yeah, all good. I can see them
Okay.
on them. So
Okay. Adelaide, I'm not sure what's happening with yours. We've certainly got the slides coming through elsewhere. Yep. Michael, thank you for that. I appreciate you confirming that you can see them as well. Okay. So advice boundaries. So talking to an accountant only last week, he had been, I'll call it almost suckered into a discussion with his client about what assets to move around and where to move them to. Now, the problem with that is even though, yes, you've got an exemption in relation to giving tax factual advice and explaining the tax implications of certain decisions that might be made, you've got to be really careful when you start going down to helping your client pick certain assets. That essentially is starting to potentially crouch into giving financial advice. Because what you've got to remember is that superannuation as a beast, if you like, and also pensions are a financial product. As soon as you're starting to talk about them as a financial product, you are going into financial planning territory. So you've got to be really careful to understand where your boundaries are and not get sucked into it just because, oh, well, that's just the answer is, and that might be okay, but just be really careful how far you go down that path. So the rules are known at the moment. The outcomes are not. And the funny thing about all of the cases that I've seen so far is that everyone has their nuances and every answer is potentially quite different. So your role is, yes, to explain the Div 296, but also we need to anticipate what it means for each specific client. And because each specific client is going to have different priorities and objectives, it therefore can mean very different answers, even though on the face of it on paper, they might look the same. So the way that we're actually going through the process with the clients, because ultimately when we start thinking about all the different decisions that go around this Div 296, and ultimately, to keep it really simple, what we are often looking at is, do we pull money out? And if so, how much? The other actions that are around that, or the decisions that hang around that mini decision, is what are the tax costs inside the fund? What are the ongoing costs inside versus outside of the fund? What transaction costs might there be? Maybe there's capital gains. Maybe there are transaction costs. Maybe there's, if it's property, maybe there's some stamp duty or legal fees associated with transferring assets. There might be Centrelink implications associated with moving these assets around. Now, I know that you're probably there saying, oh, hang on, but if they've got more than $3 million in super, how is it that they've got Centrelink considerations? Well, a little tip, I've had at least, I reckon, 25% of the people I've talked to about this so far, they have had the Commonwealth Seniors Healthcare card, and it has been very important for them to keep that card. So it is a consideration that we need to make sure that we put into the mix to make sure that we're actually giving it the due attention that it deserves. So, but as far as all of those decisions, if you were to kind of try to map out or model all of these decisions, it would be really amazingly overwhelming, quite frankly, for your client. Number one, it's actually overwhelming for you and the advisors to try to think about all these permutations and commutations that might be involved in these modelling or calculations, so that we can provide the right advice to the client. So what we've done is we've broken it down in a way that is basically a framework of how we go through the decision-making process, because depending on the answer to stage one, which in this instance, it's estate planning, depending on the answer to that, that will narrow down how many of the options in the next question, which is where, that we need to actually model or explore. So it's basically a triage mechanism where we start with a big question and we narrow down, there might be 3 alternatives in that particular question. Once we narrow down the one path that seems to make sense for that client, then we only have one path to go down to in the next set of questions. Otherwise, it then becomes 16 questions as opposed to 8. Okay, so really important, this framework. So estate planning is the first step, and really what it comes down to is, what does the client actually want as the outcome? We need to think about the beneficiaries and that intergenerational impact. What does their will say? What does their superannuation say at the moment? Have they got reversionary pensions? Do they have binding nominated beneficiary forms in place? What do they actually want the outcome to be? Because that answer is going to help us from the perspective of what we want to happen at the next stage. So the next stage is the where. So where is, if we were to take the assets or some of the assets out of the superannuation environment, where should that wealth sit long term? Is it inside or outside the super? Is obviously the first question. But then it might be, well, is it in their personal name? Is it in a trust? Is it in a company? Do some of these structures already exist? We need to really think about what is the long-term objective. And once again, keeping in mind the ultimate estate planning objective in all of that discussion. Once we've done the where and we've concluded on, okay, well, yes, we want to pull out, say, $5 million, and it needs to go into a company for a variety of reasons. Let's just say that is the triage of the framework so far. Then the next question then becomes what? So what specific accounts or assets are we pulling the money out of? And when I say assets, it's obviously, you could actually go down to the detail of which particular shares are we pulling out, or managed funds or property. But then the other decision in relation to the what is which accounts are involved, i.e., is it just the accumulation that we're pulling it out of? Are there pension accounts that have got higher taxable components and we should actually be commuting them and pulling that out? Once again, when you start getting down into that level, it is becoming a lot more like financial planning advice and not just factual accounting advice. So we make some decisions about the what, then it comes to when. And this is the timing and sequencing of various decisions, because the order and the date that actions are actually happening in can actually change dramatically the outcome. Okay, so that's our framework. Now let's talk about a real life case study. So for those of you who are looking, you can see on your screen there a link to a QR code. So if you want to pop that QR code, grab your phone out or whatever and download the case study. So the case study is basically what we're going to be talking about for the next few slides. The beauty of you having this case study downloaded is that you can follow through as we're talking about it. So please, I'm just going to give you a little bit of time to scan that. But basically, and I'll start just giving you a little bit of a preface into Bob, who is our character in our story today. So Bob is not an unfamiliar client. He's got a superannuation balance of $8 million. Bob is a widower, so he is on his own now. So the estate planning side of things for Bob is actually very important. Adelaide, in relation to the link, if you just use your phone, you can scan that QR code. That'd be great.
I'll share it in the chat in just a second.
Yeah, right. Brilliant. Thanks, Jeevan. Appreciate that. So in Bob's case, he's got about 31% of his $8 million is in pension mode, 69% in accumulation mode. He's got he's got $2 million in a property, and he's also got some shares and some cash and term deposits. So a pretty common type of mix, quite frankly, for self-managed funds. He has some adult children that he pretty much wants to leave the majority of his money to. And his pre-Div 296 situation from a tax perspective is that his super fund is currently getting a net refund every year of about $5,500, and he personally is paying about $2,600 worth of tax. So this is a really important starting base, because what it actually starts with, and I see, JC, your question there in relation to the difference between the tax, I'll call it pre and post Div 296 versus a potential company scenario. So it's really important to actually get a handle on that. So because, and I'm just going to move, I'm hoping that everybody's got that download happening now. So one of the really important things to understand very, very broadly is that the component of the income that is in the super fund that is over the $3 million. So in Bob's case, I think it's about 65% is over the 6 million limit. That income is not only taxed at whatever the super fund tax rate is, so it's more than his pension account. So let's call it normally 15%. Plus, it's then going to get taxed at an additional 15%. So you're talking very loosely, it's going to be about 30% tax. The comparison in the company scenario is, once again, about 30%. Now, in Bob's case, it may be that he just has the $5 million, let's call it, go into his personal name, in which case he may actually finish up paying even more than the 30% tax rate, which is why the company as an alternative is a really good option to be staying open to. So if you've downloaded the case study, what you will see on page 3 is that we basically show that the situation, if we look at Bob and what happens after Div 296, is that he has now got an additional tax inside the fund. Well, because of what's going on in the fund, the assessment of it is actually to him personally. So his tax, because of Div 296, is estimated to be an additional $24,000 per annum. Okay, so let that sink in, because before he was actually not paying very much tax at all. He's now having to pay $24,000 of tax out of the blue. So the question is, if we move $5 million out of the super fund for him to get him down to the $3 million level, the question is really just a mathematical thing, and that is, well, what would it look like if it was outside of the super fund? Now, without going into the details of the calculation, and you can see it on the downloaded case study. So once again, I'm just going to put that QR code up again, is that he literally, with Div 296, if he left everything in super and didn't change anything, his total tax amount per annum would be about $18,600. If he pulled the $5 million out of super, he is likely to then have an ongoing tax liability across him, the company, and the super fund of about $21,000 a year. So arguably, he's actually paying a little bit more tax than what he currently would have been if he just left everything alone. Okay? So once again, this is not an uncommon scenario. It might be that there are some small tax savings. It might be that there's some small extra bits to pay, but it then becomes a matter of thinking through the bigger picture, because it's not just all about the extra annual tax. And particularly when we're talking about Bob, who's, he's in his 80s, he's 84, and he's genuinely thinking about, what does this mean for his kids? It's really important for him. So we then start going through the journey of understanding the full situation for him. And I'm sure that you've all heard that part of the benefit, I say the benefit of this Div 296 issue is that it's actually bringing to the surface a lot of these death taxes and what the implications could be for that next generation. And at least people are talking about it and starting to plan better how they can manage that. So in this instance, if he left everything in super and say he dropped dead tomorrow, his kids would pay about a little under $1.1 million worth of death taxes. Okay, that's a lot of money. So it's not an insignificant amount. If we were to withdraw $5 million from super, that reduces by about $572,000. That is essentially a one-off saving on his estate planning tax. Can I tell you that the amount of extra tax he is paying on an annual basis is peanuts compared to what this death tax saving is likely to be? So this is where it's about making sure that we're talking about the things that are actually important to the client in this journey. So regardless, if we look at the other side of that column, he's expected to pay an additional $24,000, which will increase over time if we left everything in super, regardless. And that's a really important point to get across here. If you've got your clients coming to you saying, what could we do to get out of this Div 296? We want to plan ourselves so that we're not paying this extra tax. One of the things that I will coach you to basically be prepared to say to your client is, actually, it does mean that you will be paying more tax on an annual basis. That is just how the numbers are going to likely fall out. We will do what we can, but please have an expectation that you will be paying more tax somewhere. It's then about us trying to strategize our way through making sure we can make the most of it as we go through that journey. Okay? So let's talk about the core problem. In Bob's case, we are solving the death benefit problem, or at least more than halving it. So that's a big benefit. He's going to pay a little bit of extra tax ongoing, but there is also an added potential cost, which could be significant once again. And that is, if we have to withdraw $5 million in super, we're going to crystallise about $1.9 million worth of capital gains. Now, the timing, therefore, of that transaction is absolutely key to how much capital gains tax is likely to pay. So I'm going to direct you now, if you've got that Bob case study in front of you, head over to page 4, because what we're going to do now is talk through what this is all about. So because we are currently 30 June, or we're working towards 30 June, I know that you've all got lots of deadlines that you're probably very busy working towards. If we were to take the approach of that $1.9 million worth of capital gains being crystallised on the 30th of June 2026, then the likely capital gains tax payable would be $131,000. If we timed that transaction to happen on the 1st of July 2026 instead, that capital gains tax implication, which is one-off, reduces down to $32,000. And the main reason for that is just because of understanding how the eCPI works, because we're going to be withdrawing that fairly significant amount, and that will reduce the amount that he's got in accumulation mode. Therefore, his pension component goes from being 31% in pension mode prior to 30 June 2026, so for the 26 financial year. But in the 2027 financial year, his eCPI has actually gone up to 83%. Okay? Now, Joseph has asked a really good question. Why is there capital gains tax if Bob is in pension phase? It's because not 100% of the fund is in pension phase, Joseph. It's because in 30 June 2026, his pension phase component's 31%. But in 2027 financial year, if we pull out a significant amount out of the fund, then it'll basically increase the amount that it's in pension mode. It is purely because of that eCPI difference that makes, in this instance, a $99,000 difference in how much the capital gain is likely to be. Jennifer's mentioned that there could be some changes in the federal budget because of in relation to capital gains tax. Yes, I absolutely expect that there will be some changes there. However, the difference that it could make in relation to the ECPI, I can't imagine that that's going to change dramatically. So Michelle is then asking, so thank you for that question, Jennifer. Michelle is asking, so this is because the ECPI is based at the end of each year, so 30 June 2026 is based on 30 June 2027. No, not quite correct, Michelle. It's actually, the ECPI is actually based on the daily weighted average of how long the money was in pension mode for the entirety of that year. So it's actually an average, but because you had $8 million in the fund in this instance, on the 1st of July 2026, but then you pulled it out pretty much straight away, it's only a 31%, I'll call it pension mode for the fund for 1 or 2 days. For the rest of the financial year, it's closer to the 83,000 at 83% in pension mode. And therefore it is the average daily, it's the daily average balance that the actuary will calculate for you, which is what will calculate your ECPI percentage. Okay, so that's why the difference between 30 June and 1 July in any year is going to make a really significant difference. Judith has asked, how can he transfer out the $5 million if he doesn't crystallise the CGT on some of those assets? No. He is actually crystallising the capital gains. That's the point, Judith, is that he will crystallise those capital gains. What we're doing is we're making a decision about when we crystallise those assets. Okay? So Joseph's then asking a follow-up question. If Bob is 24 years old, why not move everything in super to pension and then withdraw $5 million with zero capital gains? Well, simply because Bob is already maxed out his total transfer balance cap. So he literally isn't able to have any more in pension mode than what he currently is. But these are all planning decisions that would have been probably made historically, I would expect. Okay, so the lesson here is that timing is everything in this with the mechanisms here. So it's understanding that daily average balance calculation of your ECPI and the fact that that single day distortion can actually be really significant. Okay. Kaylee has asked a really good follow-up question as well. So I'm glad you're actually interacting. So thank you very much for your questions. I really appreciate it. Will the cost-based adjustment on the 30th of June 2026 contribute to significantly lower the CGT redisposal of assets on the 1st of July 2026? So let me just clarify. The cost adjustment on the 30th of June 2026 that we're able to lock in is not for capital gains tax purposes. It is only for calculating what the capital gain is that's going to count towards the Div 296 earnings of the member. It is not changing the fact that you still have the same CGT event for capital gains tax purposes. So what's going to happen with that CGT adjustment is you are going to finish up having another cost base that we have to keep track of separately, but they are used in very different ways. Okay, but really good question. I'm glad you asked that, Kaylee, because it really was very relevant. If the benefits were crystallised before 30 June 2026, no Division 296 tax will apply. However, thank you, Monica, for this question. However, if crystallising occurs after the 1st of July 2027, any associated capital gain will be subject to the Div 296 tax in addition to the capital gains tax. You're almost correct there, Monica. What it is you have an option to re-establish your cost bases at the 30th of June 2026. So yes, you will still pay the capital gains tax as per normal if you were to do this on the 1st of July 2027. The difference is, though, if you have chosen and opted for resetting your cost base, then the capital gain that you will be calculated on for Div 296 tax purposes will only be the gain from the 1st of July 2026 onwards. This is, I think, another example, moniker of simplification gone horribly wrong. It is going to be really quite complex keeping these, and this is where we thank you, Jeevan, BGL, for your wonderful coding skills, because I know that the guys are already on the case in relation to the mechanisms associated with resetting that cost base and keeping track of those extra calculations and second lot of cost bases for our assets. So I know the team are already onto that. So thank you, BGL, very much for your attention to that. I think I'm just going to keep moving along because I feel like we're going to get bogged down in some of these questions as much as I love taking the questions as we're going. So let me come back to these. I'll just keep moving into our next case study and example. So the key point that I want to make to you is that there are some really key and unique windows that are open at the moment, but they will close. And the reason for that is that the 2027 financial year is structurally very different from a Div 296 perspective than subsequent years will be. That's because 227 is the first year of the operation of Div 296, and they are basically giving us a little bit of a chop out in that first year, in that subsequent years you will be measured on the 1st of July and the 30th of June in that year, so the beginning and the end of the year, and whatever the proportion is that's over the 3 million or the 10 million, as the case may be, at either of those points in time, they will look at both of those measurements and they will take whatever the higher percentage is, and that's what's going to lock in how much you get taxed. So it means that we have got the ability to make these structural changes on the 1st of July, potentially, rather than the 30th of June 2026, and get these extra capital gains tax savings without necessarily triggering the Div 296 tax for the first year being the 2027 year, okay? Later years are going to be very different, okay? So this is very much we need to be thinking about this now and potentially talking to our clients about this in the next couple of months, okay? But once you miss that window, it's not going to come back. We will still have the opportunity to make decisions on the 1st of July 2027, of course, but that won't get us out of having a Div 296 problem in that year, because on the 1st of July it will have been measured and you will have already been over the limit. So really important to understand that distinction. Let's talk about Gus, who is my second case study. And I'm trying to just get across a couple of really practical things for you to be aware of in relation to some of these rules. So Gus came to me, he had a self-managed fund that had about $5.4 million in it. And on the face of it, that was, had a property, or actually had two properties, and then some managed funds, some shares and some cash. It looked pretty manageable at that point. But then as we dug deeper, and it's like the tip of the iceberg as I've got there in the picture, how many other things start bubbling to the surface. So in his case, he had a lot of industry funds. So in addition to the $5.5 million that he had in a self-managed fund, he also had in fact, he had three industry funds. Two were just accumulation accounts in industry funds, and then another one was a defined benefit interest that he was receiving a pension from. So all this was to say that his exposure to Div 296 is quite different because of these other elements. And this is a really good time to highlight to you that one of the things that we were obviously lobbying pretty hard in the original legislation against was the fact that the Div 296 shouldn't apply to unrealised capital gains. Everybody seemed to be up in arms about it, and obviously that was taken off the table. Now, was it though? Because actually it wasn't. For self-managed funds or for small funds, yes, it no longer is capturing unrealised capital gains, so long as you make the election and reset your capital gains tax cost bases on the 30th of June 2026. However, they are not doing the same sort of mechanism in relation to your larger industry funds. For those, basically, I think it was just deemed to be too difficult to try to track that. So what they're doing with those funds is they're basically just easing in the capital gains as far as how they're actually calculating the Div 296 earnings applicable to members. So basically what they're doing for those industry funds is they're taking the capital gain part of the earnings equation. And they're basically saying, well, in the first year, we're just going to count 20% of that capital gain. In the second year, we're going to count 40%, third year, 60%, and so on and so forth. So by year 5, they are then counting 100% of the capital gains in those industry funds earnings calculations. But it is still, a mix of various capital gains. So I found that quite interesting as to the mechanisms associated with it. And defined benefit interest is a different calculation altogether. But really, the main thing that I want to get across to you here is that we had a lot of things that we needed to think about for Gus that were a lot beyond what we were just doing with the self-managed fund. We also needed to think about, what are we doing with these industry funds? Are we keeping them? Is that where the money comes out of? And once again, lots of different decisions that are associated with that we need to work through with Gus. Okay. But I thought it was an interesting case to bring these different, opportunities or considerations to the fore. So a couple of the lessons that I want to get across to you is, when you're looking at these Div 296 issues in relation to self-managed fund clients, which a lot of them are, some aren't, but a lot of them are, I've found. You can't only look at the self-managed fund. You need to get behind, if you are not their personal tax agent, you need to be able to get in touch with their tax agent, get some ATO portal printouts, or get those from the client to understand what their total superannuation balances are and what else is out there, or what could be out there. So there could be some legacy accounts that really, quite frankly, the client may have overlooked or has been forgotten. And once again, it's one of those things where if all you do is you keep asking the client for these questions, and they might not deliberately mislead you, but you might get misled if you just rely on what they're saying. Okay. So be careful of that. Watch out for those circumstances. Okay. So applying the framework in Gus's particular situation. So he was a different situation. So once again, thinking of that framework, estate planning, where, what, and when. So in this instance, the estate planning issues for Gus weren't really his primary concern. He had some nephews and nieces that he wanted to leave some of the money to, but a lot of it was going to charity. Therefore, remember that if the money is going directly to charities, then they're not taxed the same way as what other non-dependent beneficiaries are going to get taxed. So his nephews and nieces were likely to get taxed at either 15 or 17% of the taxable components of his super funds, but the charities wouldn't be taxed on that at all. So it could be that he could achieve what he wanted to reduce the estate planning tax simply by channeling where the estate monies were coming from and going to. So, for example, he might have the superannuation assets going to the charities, but his other assets going to his relatives. So there might have been a different way for us to attack or tackle the estate planning considerations. So this is where we need to be very specific and talk to the client specifically about what's important and think about how it all works in together. So the second question then is the where. So in his instance, he had a lot of property assets. He was very property heavy. And he actually had tax losses carried forward for the last couple of years because of he's in Victoria, so he's got lots of land tax costs and pretty poor yields in relation to some of these properties, and he had specific reasons for that, which were fine. But basically, he had a very different situation. But once again, he was in a situation where him having the Commonwealth Seniors Healthcare card was very important to him. So for him, One of the things that we wanted to explore was maybe one of the properties coming out of the super fund and going into his own name. Because if we have it going into his own name and not into a trust or a company, then there is the opportunity for that to come out without having any stamp duty cost. Now, that's going to be a fairly significant transaction cost that we can avoid if that makes sense long term to do that. We needed to look at the land tax implications, whether we leave it inside or outside of super, and we need to do a lot of number crunching to work through all of that with him. But the other thing we wanted to do was control where the income is and when, so that we could make sure that he could maintain that Commonwealth Seniors Healthcare card for as long as possible. So for him, one way to achieve that was actually to have the liquid funds, not the property, but the liquid funds, so the managed funds and some of the shares, etc., go to a company structure, with him being the owner of those company shares. Now, you could have it as a family trust if he was intending to distribute that to some of his relatives, and that's something obviously we need to talk to him about. But the benefit of having in the company is that even though the company is paying 30% tax, and if we had that income in his personal name, arguably he would be paying less than 30% tax. But at least in the company, we can control how much tax we're paying and when, i.e., the Centrelink part of the story. But what it also is that even though the company might pay the 30% tax, that's not necessarily a final tax, because we can strategically every year declare a dividend once the company has actually paid some tax and has got some franking credits saved up. We can then start paying franked dividends out to Gus, and basically him then potentially get some of that tax back as a tax refund, because he's got these losses that are being carried forward that we could use up strategically over time. So as you can see, we really need to have a really good understanding of not only just the superannuation rules, but how the tax rules could work in those types of environments in order to get the optimal result for the client. The next question then is the what. So is it the industry fund assets that we remove in order to get his total super balance down? Once again, a lot of that depends on, he's going to say, well, show me how the industry funds have gone. Let's look at a comparative thing that we can have invested in the company. Let's look at the comparisons there, and then we'll make some decisions. He also wants to start letting go of some of the control that he historically has had on some of his share and managed fund decisions, because he's getting older and he's starting to understand that maybe he won't have the cognitive ability long term to be able to continue to do this forever. So, all these things aren't all necessarily dollars and cents and, spreadsheeted numbers. Some of this is how they're feeling and how we can actually get them understanding what their transition years might look like. Then there's the timing decision. So this once again comes down to, is it a 30 June, 1 July thing? Is it a 30 June 2027 thing? And that depends on the nature of the assets that are in the super fund. What are the ECPI implications? What are the likely capital gains tax implications? And let's just work through the numbers to see what works best. And the best way that I tend to look at these things, quite frankly, is just do lots of what ifs and then share some of those results with the client so that they can participate in those decisions with you. Okay, so case study 3, and this is just to illustrate where there might be situations where people that are over the $3 million, but maybe it's okay to leave it in super. So this is a really good example of that. So Laurie and Peter, we actually worked with them probably, I'm thinking it was about 5 or 6 years ago. We segregated their assets in super. Now, remember, you can't segregate asset earnings in super anymore. So the way we did that is to actually set up 2 separate superannuation funds, with one of them being mostly in pension mode and the other one being mostly in accumulation mode. And the one that was mostly in pension mode had this particular asset that they felt pretty strongly was going to increase in value, with certain things in place. So we actually put that strategy in place about 5 or 6 years ago. Now, up until 12 months ago, they weren't really seeing that growth happening. But luckily for them, in the last 6 months, that has actually now happened. So we've now got this high growth asset that was specifically placed in the fund that had more pension component. And therefore, it was a very deliberate decision to now look at what their overall position is. We also, prior to them starting these pensions, did lots of benefit recontribution strategies and things like that, so that their components that were taxable in that fund are actually really quite low. So very, very manageable. So the numbers here will knock the socks off you, because, you know, this is one of those really good news stories. So their total superannuation balance went from about $4 million at last 30 June 2025 to, as of a couple of weeks ago, their fund balance was worth about 13 mil. So 30 June 2025, $3 million in Div 296 wasn't a problem for them. Now it is. But you know what? I would love to have Div 296 a problem, and this is one of the things that I'm aspiring to. So, but basically, what it leads us to then is there a problem here? And this is where going through the process of understanding how the numbers work together, because remember, one of the reasons why Div 296 is a problem is because it's going to cost them more tax. But maybe it's going to cost them more tax, but maybe it's actually worse if they take the money out. So in this instance, once again, working through that same framework, we look first at the estate planning issues. Because we had historically already done some really good work to get lots of tax-free components into that pension side of the fund, really, on a $13 million fund, I think that the total death benefit tax potential cost might have been $300,000. So really, in the grander scheme of things, that was actually very manageable. So let's discount that. And also, there's two of them, right? So if something were to happen to one of them, then the other one has got some time to work out what we do. We don't have to do anything straight away. So that's a really important point, that it's a very different set of decisions for a couple compared to when you're talking about a single person, okay? The second one, where? So we've still got some accumulation accounts still in super. Maybe there's a couple of $100,000 or $500,000 that might be in accumulation mode that might be worth getting out. But once again, it's probably not really going to move the needle dramatically. What? Well, there's lots of liquid funds and managed funds, as well as shares that we can use. And also, once again, there's some accumulation accounts and balances that we would probably look at maybe moving out, but not significant amounts. And then the final thing is when, and once again, it's probably we can be quite deliberate about it, because their asset base has a mix of assets that are in profits and assets that are in losses. So we could actually cherry pick the $500,000 that we might want to move out and just pick the things that are in losses and not actually crystallize any capital gains. So that timing issue isn't that big a deal. Okay, once again, very manageable. Okay, so once again, just because your client is over the $3 million might be that that's actually still the best thing to leave it in super. And once again, because they are in pension mode, I'll call it the underlying tax rate is nil on those amounts. Therefore, it's only the extra 15% tax that we're paying. If we move it outside of super, you're then going into potentially a 30% or, you know, a mix, potentially more, but let's just call it 30% tax rate. The 15% tax rate on the stuff that's in super is still the best option for them at this point in time. But I thought it was a really good example just to show you that moving money out is not always the answer. Okay, so we're getting to the end of the presentation. So I really want to now hone in on the actions that I want you to take and to go through in order to know what your next best steps are in relation to your clients. So number one is to identify or flag every client that has potential total superannuation balances that go over the $3 million, not just the self-managed funds. Now, unfortunately, it's really difficult to get a list of your total superannuation balances for your client base out of the tax office ATO portal system, unfortunately. So BGL has got a report that you can run on all the member balances. And part of what we're going to send you after this session is a copy of the slides, but also some instructions on how to get that list out of BGL. So that's, once again, a really good functionality in the BGL system. So identify those clients that have this $3 million thing. The second thing then is to confirm the exposure that they have. Now, they might also have other super, so be mindful of that. But BGL has a really good tool that will help you to at least just give your clients a little bit of a snapshot of what the likely impact of Div 296 might be to them, just as a first pass for communication purposes. So there's a tool in there that is really helpful. So the third step is then to actually quantify the exact implications that might affect them in order to work out if the numbers are actually creating urgency and clarity. So it's not just, remember, that's not just the Div 296 tax number. It's then about, well, what are the gains? What's the death benefit tax implications? What else is going on outside of super? Essentially, what we want to get it to a point of is we want to triage the clients that need immediate attention and maybe need a more complex strategy, or that we need to prioritise because timing decisions really are important in their case. So they're the ones we want to try to triage it down to those special clients, okay? That's what we're trying to achieve. So then the approach that we take is we then go through that framework of understanding the estate planning, the where, the what, the when, okay? So that is our framework. The key that I will say to you now is to know your lane. So if you're an accountant, you can explain what Div 296 means for the client and what it means from a potential cost perspective. But as soon as you start going into recommending what they do about it, that's delving into the advice element, and that needs the financial planning elements, okay? So just be really careful where you are at there. Now, I also go the opposite way and say financial planners, and I know that there are a number of them out there where they are more, I'll call it investment advisors, as opposed to holistic financial planners that have the depth of accounting and tax knowledge to be able to support some of these pretty complex decisions that need to be made. One of the first Div 296 examples that I was looking into was a client that had, I think he had about 15 different structures, various trusts, companies with Div 7A loan agreements and things, and using some of the money that we were going to pull out of super to put into a company environment. Not only did it make sense from an annual tax perspective, it actually solved some other accounting problems that there were embedded in his structures by solving some of these Div 7A issues. So instead of him having to have mandatory dividends paid out to him and his wife of more than $500,000 a year, we were able to eliminate that and actually have a much more holistic solution as a result of looking into his affairs. Now, I'll call it your investment advisors or brokers, they will not be able to cope with or deal with things in that sort of a holistic way. And I think they probably need to stay in their lane and actually either collaborate with you as the accountant or the tax agent to be able to bring all these ideas together, or come to someone like TAG who kind of can talk about all of those things. So the final couple of things that I want to probably try to get across to you is just to give you some tools in relation to how to talk to your clients about this. So once again, there's the what to say and what not to say in those two columns. So I would actually suggest basically just saying things like, let's understand your exposure first before we make any rash decisions, because it's more than just this Div 296 tax that is important for us to understand. There are trade-offs with every option. Let's just make sure that we're making the right decisions as we're going along. the amount of people who who I've heard say you should just pull your money out now, and this was in some instances I had some clients telling me that they got told that years ago. Well, that was way premature because the legislation hadn't even been settled 2 years ago, and yet they were taking millions of dollars out of super and really painting themselves into a corner to a certain extent. Making the assumption that everyone over $3 million needs to restructure or pull money out is once again potentially wrong. We need to look at the entire situation and make sure that we have done the appropriate modelling to get the client's answer right, to optimise their position. Okay. So, final thought, the urgency of strategic planning. Timing is not just about admin, it's about strategic decisions we're making. Structure is not neutral. It is really important for us to understand what the structures are that we're going to go into. And ultimately, what we're trying to do here is to plan now, not necessarily that we want to activate things right now, but we might want to be very strategically getting ready to activate things in July. So that's the approach that we're taking. We are here to support the accounting community. We've been working with BGL, as Jeevan said, for, I think it's almost 30 years. We're not here for anything other than to benefit the people in this community. So, if you enjoyed today and you enjoyed the practical case study based approach, don't forget and scan there if you want to go and have a look at the Super and Tax Strategies Day that we've got coming up on the 21st of July. That is in person but also virtual. We love to see as many people in the room. In Melbourne, it's a lot more engaging that way. BGL are going to be there. They'll have a few people representing there, and I know that we always get them involved in the discussion, and particularly with this Div 296 stuff to get us updated on some of the things and the strategies that they are building into their software to help us with this along the way, which we really value. That's time for me. I will hand over to Jeevan because I know that he's got a couple of things that he wanted to share with you as well. So let me just find out how I can unshare, stop sharing.
I've stopped
And
sharing, so it should go already. So thank you, Michelle, for that. So just very quickly, I guess, just so you know, everyone knows what's happening in terms of the BGL landscape. So as Michelle mentioned at the moment, within Simple Fund 360, you do have the ability across your fund list to actually filter based on the TSB balances. So if you have put in external balances, we'll obviously incorporate those. If you haven't got those recorded within Simple Fund 360, it won't. And there's also the AI assistants that can do the Div 296 calculations. We'll then roll into the next couple of phases. So I guess, as I said, moving on, phase two. This is currently, I guess, being built at the moment. There will be several, different types of reports, minutes, letters. As you can imagine, I think we've got, a list of up to 10 at the moment. In terms of the CGT election, we're waiting to still hear back from the ATO in terms of how that actually gets reported back to the ATO, if at all, in terms of the mechanism. So they still haven't confirmed that in terms of final. As Michelle mentioned, obviously we'll have the ability to run that election there within a screen. There was a question that did pop up early on, even about how we're going to actually manage the likes of a wrap account that has been recorded as a single investment. I can't answer that categorically, but we are playing with a few different ideas at the moment. But because it hasn't been built, I don't want to say this will be the guidance and absolutely 100% case. But please know we are. It is all being built as fast as we possibly can with that. There will be obviously the functions to automate that. And the good thing, I guess, compared to the previous ones, and we'll obviously maintain two separate records. And there will be some, obviously, from a software point of view, some situations that you may obviously face in the future that we'll definitely cater for, such as taking on an existing fund where you need to maybe bring those balances in manually and the likes as well. So we'll provide guidance as time goes on and those things are built. Post July 27 is obviously The next part is the actual tax itself, the calculations, and obviously reporting through to the tax office. So we're currently engaged with all the actuaries about how that's going to work from the certificate that needs to be received there from the actual actuaries. Obviously, the ATO wouldn't hasn't released you know these details in terms of how we actually report to the ATO this far out. There will obviously be a lot of changes around SuperStream in terms of the release authorities, etc. And we will see obviously a lot of changes to the year-end process, which is create entries in Simplifund 360 in terms of the actual earnings, and then we obviously earnings for Div 296 purposes and actual fund earnings, which gets obviously allocated for SIS purposes. So you'll see the two different calculations and I guess reporting there. So there's a lot going on in terms of not just strategy, as Michelle's shown you today. There'll be a lot in terms of SMSF administration as well. Michelle, thank you very much for your time today. I suppose it's been extremely valuable and I suppose a lot more information there. If you have any follow-up questions there to Michelle and the team there at TAG, Michelle's details will be included in an email sent to everyone, as well as a link to obviously a recording of today and a copy of the slides. And I suppose if you want to get some in-depth practical examples, obviously get along to TAG's super seminars as well.
Brilliant.
Cool. Thank you, Michelle. Thank you, everyone today. Bye for now.
Thanks, everyone.